how we are doing the business valuations. Okay, forecasting techniques is that how it is, how the yield curve will have impact, how the rate of interest will have, how the credit spreads will have. Okay, how to value the corporate debt. That valuation of valuation of free cash flow. Okay, we will have free cash flow. Is that free cash flow to the firm? Okay, how based on the future ability to generate cash flows. Okay, and on the discounting basis. Is that we will take into consideration apply asset based. There are three things: asset based, income based, and cash flow based approach to equity. Okay, there are three different methods are there on which we are going to work it out, including term structure, interest rate, yield curve, credit spread, forecast organization, FCF. Okay, FCF they will ask for free cash flow. Okay, value the organization using the free cash flow to not only FCF, you have FCFE. Okay, free cash flow to equity. Okay, you have two things. One is free cash flow, one is free cash flow to equity. Estimate potential near-term and continued growth levels. Company earnings using both internal and external measures. When you are doing the things, see this is the difference they will create. Okay, there will be a concept of a quoted companies and there is a concept of a unquoted companies. Okay, there is unquoted and unquoted company. Same thing, whatever the methodology, the language. Now you are more familiar with the language rather than before. Is right? You are talking about when you are using it is a book value plus market based model or cash flow models. Appropriate such as risk adjusted cost of capital. Risk adjusted cost of capital, something they will use like this. Okay, see this, we have done this. Is it? No, we have not done this. I'm just recollecting. Adjusted net present value. Any idea about adjusted net present value, why we calculate?
To have a clearer picture of the financing effects.
If the overall company will take, if the overall project or overall company asset, then we'll say net present value. If you want to calculate the cost of a specific project, then it is a adjusted net present value. Changing price earnings. Okay, changing price earnings multiples, changing price earning multipliers. Is it acquisition or mergers? Fine. Understanding the procedure of valuing the growth startups and loss-making companies. This they will test. Loss-making companies is the most difficult, most important one. It's not like that. Okay. Now, overview of the, whenever you want to stop, tell me, okay, I will be here. But I will stop after 10 minutes maximum. Okay, maximum 10 minutes. Overview of the methods is a dividend valuation method, FCF and FCFC. Market-based method, capitalization, price earning, market to book. Asset-based methods, okay, replacement and intangible. If you've done financial management before, okay, in depth, definitely we are not going to in this much detail, but we'll have some few of the methods. Market capitalization based on the book value, realizable value. Okay. See, they mention very clearly. Do not put yourself under pressure in the exam to come up with a precise valuation, as business valuation is not an exact science. In reality, final price paid will depend on the bargaining skills and economic pressures on the parties involved. Okay, means we can use a one of the method which with proper justifications. Okay, the proper justification. One is cash based methods. They very clearly is it that immediately it will be there which one we have to use. Is it which one we have to use? But we will get a clear indication when in the question that which one we have to use. The theoretical premise is that the value of the company should be equal to the discounted value of future cash flows. Most appropriate based, okay, most appropriate. We will discounting the future. They're all estimations only. Okay, market based where we assume market is efficiency, market information. Okay, where the market is efficient. These are share prices and PE ratios for the target company and other company. The assumption that market value is consistently, if necessary, value of one company can be found to value of similar companies. Okay, asset based approach. If they are having higher level of intangible assets, it is difficult to apply. Free cash flow, okay, free cash flow. You will come across this word again and again, okay. You will come across this again. Means, see, when you are doing this, is it that we will what we will do? Maximum we will estimate for how many years? 5 years. Then after 5 years we cannot estimate. See, 5 years estimation is also not accurate, as simple as that. But in theoretical, in learning process, we'll take 5 years. Okay, we take 5. But beyond 5 years, we'll say it is free cash flow. Is that can be used for the valuation of the firm in determine price of the mergers to identify for the share price of the sale of block of shares and the share value added. Technically, for the value of the business activity determined, free cash flow for all years can be estimated. However, rather than attempting to free cash flow every year, in practice, a short method is applied, divided into 2 time horizons. Those occur. That's why I say planning horizon maximum 5 years. Okay, maximum 5 years, and when beyond, okay, those occur after planning years. This is going to be beyond 5 years. This is the flow we have to work out when we are doing the things. Okay, this is the if you talking about the section 1, it should be like this. Okay, value of the firm using the free cash flow. You have to know what is the forecasted future cash flows during the planning horizon. Beyond, which it is less than 5 years. Okay, less than 5 years. It is more than 5 years. We call it as a continuing or terminal value. Discount free cash flows for the period. Find the present value of the flows. Based on the growth rates. We assume that we say that if you have any idea, perpetuity. Okay, perpetuity with growth. Perpetuity without growth. Okay, perpetuity with growth. Perpetuity without growth. Okay, those things we have to use those calculation models here. Any short-term investments is there in terms of what? In terms of working capital. Value of the firm and less value of the debt. Okay, value of the value of the firm minus value of the debt. You'll get the value of the equity. They gave. See, we will stop where there is a question answer session starts. We will stop. Okay. question answer session, we will stop. No, it will be more bigger one. Okay, don't go quickly. Okay, just have patience. Inshallah, it will work. Okay, so planning horizon, they can earn above average returns, less than 5 years. Is that they can grow, they can grow, they can earn. Okay, above average returns. Cash flows are assumed to grow over a period of time. Is that beyond planning regions, beyond planning horizons, returns are expected to reach a steady rate, constant growth rate. We use the word. They will give you in the exam, the question. Okay, they will give you in the question the constant growth rate. Here they have said which here they say which may last up to 10 years or more. But usually they will not take that much. Okay, they will not take that much. Here the concept is not to repeat the same process again and again to make you understand. A company prepares forecast of FCF. We will complete this, do this, and stop. A company prepares a forecast for future cash flows. A period of 15 years is used to represent a typical time horizon. It is assumed that planning horizon is 3 years. Returns are likely to grow each year for the first 3 years, and after that they will go at a steady rate, a steady growth. Now, for free cash flows are expected 2.5 in the year 1, 4.5 year 2, 6.5 year 3. Fine. The stock market value of debt is 5 million and the value of is 10. Understand very slowly. Okay, understand very slowly. Here they have given you only for a small concept. In the examination, they will give you this. In the questions, they will give you this with multiple attachments. Okay, with multiple attachments. Here they are talking about 2.5, this one. Is that they have taken the discount factors. Is that they have taken the present values and they have multiplied with the present values. Is that it comes to how much? It comes to 45,315. From there, they have deducted what? They have deducted the loan. They have deducted the market value of debt. You got the value of equity. Very, very important. Okay, free cash flow to equity. This is not free cash flow to equity, but these are the concepts which is going to help you out in reaching the conclusion. Fine, because it is a consistent approach, they have taken the annuity factor. Is it okay? Can I stop now, please?